You are listening to Insights from the Conference Board.
Welcome to Insights. I'm Amy Abel with the Conference Board. I had a terrific conversation with my guest, Solange Shiraz, Distinguished Principal Research Fellow at the Conference Board, who is also founder and CEO of HC Moneyball. I'm also joined by Larry Bieferman, Fellow at Labor and Work-Life Program at Harvard Law School. Thanks for joining this conversation. I'm very excited to have all of you join me today, and I'm delighted to share with you some insights about a new research report that we've just released. It's called Brave New World, Creating Long-Term Value Through Human Capital Management and Disclosure. And I'm going to ask my colleagues to talk a little bit more about this report in a second, but it's really about a change in our business environment and how we are looking at the people aspects of our organization. How do people engage in our organization? How do we report on how people engage in our organization so that all stakeholders in our communities can understand how we actually operate, right? How do our people contribute to the value of the organizations in which they exist? So I'm very excited to have my guest join me in this digging deeper into this topic around defining materiality for human capital disclosure. What does it mean? What does it look like? How should we think about disclosure and our human capital management practices? And basically, again, looking at the big picture of how do people engage in the organization. So with that, let me start by turning to Solange. And Solange, could you tell us a little bit more about this new report? What's been going on? What drove this report, and maybe some, one or two key findings of this report?
Sure. So, Amy, thank you for including me in this podcast, and I'm delighted to be joined by Larry, who I hold in the highest esteem, and I'm always so honored to be in a conversation with him. So, I'm glad to be here and speaking with him. To answer your question, the new report really addresses the attention that needs to be given to human capital management as an ESG issue. So it's not just, do we have the right programs in place for people? Are employees happy? It goes further than that. It really gets to governance issues, and it gets to the economic impact that our workforce, our human capital has on the organization. We spent about 18 months studying this topic and having very deep conversations with experts on the topic to really understand how companies, especially in the boardroom, should be thinking about these issues, should be dialoguing about these issues, and should be advising management, which is the role of the board, to reframe how they think about human capital and human capital management in the organization. And we got to this point, I think of it sort of like a tsunami. It started with a little shakeup someplace, and it grew into a big wave that basically culminated with the SEC requiring that public companies disclose on human capital management if it is deemed to be material. So what does that mean? That's where we are in the conversation today, is what is materiality and how do we understand it? How do we reconcile? How do we align and I'm going to steal something that Larry said, the internal narrative with what we tell our external audience? And hopefully, we'll be able to address that more. But I think what we want to do is just tee up this concept. What is materiality? How do we think about it? How do we manage it? How do we track it? How do we baseline it, track it, correlate that to corporate financial performance, and then ultimately disclose on that to interested parties of the organization?
That's terrific. And let me direct this to Larry. Again, thank you, Larry, for joining us in this conversation. You have actually been doing research in this space for over 10 years, and you've seen the trends, you've seen the evolution. Can you share a little bit about your experiences and your research on how this trend has evolved to where we are today? How does it come about to why we're paying so much more attention to it today?
Well, thank you, Amy and Solange. It's a delight and pleasure to be working with you and have the benefit of your insights, which I guess is far exceed my own, but I will contribute what I can. My comments in a way arise from my experience of heading up what was called the Pensions and Capital Stewardship Project at Harvard Law School, starting in 2004, and my current work, among other things, as a fellow there. Just to set it in perspective, what's happening now represents sort of the confluence of two developments over 40 or 50 years. One piece of it is sort of obvious, dramatic changes in terms of the impact of global trade and competition, technological changes, the character of industries that produce goods and services that have changed the context and demands with regard to the folks who are engaged in enterprises. A. B, what are the import or consequences for the people who work at those enterprises? A rather dramatically different world in many respects for them by virtue of that. So there are both those things going on. My work particularly comes out of the sort of investment dimensions of this larger discourse and sort of put a context on it. Given the kinds of tools that workers have, especially in the United States, all right, as it turned out, the investment community was a modality whereby workers could advance discourse with regard to those issues, right? The same issues that companies are dealing with in their own way, in part because of the vast amount of wealth in retirement systems. Right now, the U.S. retirement system has about $30 trillion in assets, right? So the pension or retirement funds provide an enormous number of resources in which key players, including public sector pension funds, could play a role. Right? So they were in part drivers of a conversation on these issues. Second, reaching back probably, I think, to the 1970s, there were a small number of faith-based investment funds driven by religious values, which took up issues from South Africa on over, labor and human rights and what have you. And they've been around and are still around and actually pull far beyond their weight, if you will, on these issues. You have a confluence of the faith-based investors, the increasing retirement assets, and also the larger asset management market under the rubric of responsible or sustainable or ESG investment, which are in a way that in a way reflects developments in the society about the importance of these issues in general terms.
Larry, I guess those faith-based organizations have to answer to a higher authority, as it were.
Thanks for that, Solange.
But it's good that they're leading edge on that.
So that's sort of the context for the work that I started at Harvard, the Pensions and Capital Stewardship Project, and sort of setting it within the context of the last 10 years. Early on, we did a paper on corporate disclosure with regard to labor and human rights and supply chains, which was our opening paper for a variety of reasons. But then we convened a conference, and we had at the conference pension fund people, asset managers, unions, human resource and labor academics, a variety of civil society organizations. That was the character of a rather broad gauge conversation about the state of the field. The state of the field was sort of the intersection between workplace issues and, if you will, the investment world. We had about 40 people there, fascinating conversation. That was the good news. I would say the bad news was the issues, it was clear, were not on folks' screen, and efforts at disclosure as one element of that broad discourse was minimal. Right? Fast forward today, a very different conversation. That is, the questions we're talking today are very, very prominent, and lots of people are focusing on what's been going on. Again, I think the cumulative effect of the faith-based and the public sector pension fund investors, then the movement of that beyond those actors, I think particularly interesting, I think driven by climate change. The importance of that issue inspired and spurred investor activists. And in a sense, they built up the conceptual, methodological, and practical infrastructure for engaging companies on that issue. But the spillover, in my view, effect was to create a platform for engaging on broader issues.
That sounds great. That's really helpful to think about how all the different stakeholders have influenced, right? These are our organizations now, especially on human capital disclosures and materiality, right? It's really, as you're saying, just this evolution of different influences, different stakeholders, which led to this SEC ruling for today. Let me shift the conversation a little bit
Look,
to talk about. So,
just one footnote. So, for example, the I would say one of the major factors, hardly the only one, in triggering that regulation was a petition from the Human Capital Management Coalition, which we worked with actually before they submitted the petition. And that's a coalition of public sector pension funds and certain asset managers and others. There you have it, if you will.
yeah. But again, more stakeholders, right? Lots of pressure of stakeholders influencing our organization, which has definitely been a very broad trend across all sorts of issues, as you've already summarized. So let me shift to asking the both of you. So what are companies doing or should be doing? Do we have some practical recommendations around how organizations and HR practitioners can think about some of this? And maybe Solange, I can turn to you first, either from the report or, from industry. What are some guidelines or recommendations, or how should we be thinking about materiality?
Yeah, so that's an interesting question. And I'm actually going to let Larry address this concept of defining materiality, because there's actually two different domain spaces. There's the accounting and finance, and then there's the legal. And so it gets kind of complicated on how you want to frame the question of materiality. So let me sort of go to the practical side of it, which is less about disclosures and more about really understanding the fundamental economics of your business. And I think that board directors, and having been one myself and sat in boardrooms for 15 years, can attest to the fact that we spend a lot of time going line by line through our financial statements. We don't spend any time really, any substantive time or attention on the unit of labor as a driver of economic value. We sort of assume that people are going to be in the equation. We sort of assume that labor is a commodity that we can get it wherever we need it and whenever we need it. And we certainly don't focus on human capital as a driver of economic value creation. In the boardroom, we've started talking a little bit about culture and about employee engagement. We definitely talk about the top 5 paid and executive management team, but we don't talk about the collective human capital in the organization. And the one thing that the SEC acknowledged in their deliberation around the disclosures of human capital management materiality was this acknowledgement that human capital is an intangible asset. It's basically changed the nature of how we think about human capital. It's not simply an expense anymore. It's something that we need to invest in. So, I would love to see all of our organizations actually calculate HCROI and HEVA and HCVA and HCMV. And if you want to know what those mean, read the report. But there are ways of actually measuring the return on investment in the broadest sense of human capital. But that's sort of like running before we can walk. I think we really need to understand the connection between people and how people are treated and how people perform, their level of productivity, the way we conceptualize, the way we frame our workforce before we can actually jump to measuring and taking action on these macroeconomic level indicators. And I think we need to be thoughtful about it. I mean, I would love it if organizations were calculating this to sort of understand where they need to dig deeper in their organization. But what we're seeing, and I'll let Larry address this, what we're seeing is a trend in the filings that have occurred since November 9th, which is the first day that the SEC had set for compliance. We're really seeing softer disclosures around policy issues, diversity, workforce strategies, culture. And I think that's great. I think that that's a perfect first step, is to really, and I don't want at all to equate, for anybody to get me wrong, I'm not saying that companies are alcoholics, but in Alcoholics Anonymous, the first step is to admit that you've got a problem, right? Before any positive before healing can begin, I think that organizations need to actually take a hard look at themselves and figure out who they are. Are they an employee-centric organization with the right programs in place, or are they the same old manufacturing-centric, technology-centric, customer-centric, and think about employees as a commodity?
Okay. Okay. Thank you for that. That sounds great. Let me turn to you, Larry. Your thoughts on either what you've seen or heard, what companies are doing, what are they struggling with? What do you think?
First, I want to get back in a way to pick up on Solange's point to frame what I'm going to say, because I think we have to be careful, or my view, we have to be careful. Yes, the conversation is about materiality, but also it's not about materiality. It's materiality in a very concrete sense because the SEC has issued regulations under that rubric for particular legal reasons. So you certainly got to attend to that. But as my sort of intro about how we got here, how we got here involves sort of an interplay between, if you will, company/investor related concerns and worker related concerns. And the drivers behind disclosure in the immediate context of the SEC, both of those are behind that. And I'll allude to maybe toward the end of our conversation what I think is going to go forward. This is a piece of a much larger thing, okay, which is going to press on both perspectives. So I think we have to certainly focus on materiality, but understand it's really a twofold conversation. The fact that, particularly in the US, the conversation is framed in materiality is because of I'll call that the point of the leading edge, if you will, has been more in the US, I think, compared to other countries, been investors rather than workers themselves. They haven't got quite the same tools. So it's the language of investors, and that's where the materiality notion comes from. Okay, what did the SEC say? I'll quote the language first. This is materiality, all right? This as defined by the Supreme Court supporting the SEC. A fact is material. I'll get to that. A fact is material if there is a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the, quote, total mix of information made available. Right? Interesting point. It doesn't say the company's perspective. It says the investor's perspective, which I find intriguing, right? Because it raises the question of how do you have to think about what investors look like? This is in this context. All right. Also, this language doesn't mention what do you use this fact for. Implicitly, though, it's about some notion of financial reward and risk, which ostensibly most investors are concerned about. All right. So we have a regulation which is compelling disclosure, informed by the notion, some murky notion of materiality, defined here, arguably in the service of what investors care about in some important kind of way, as suggested by the language, which has a very important financial dimension, predominant, overwhelming, though I would suggest not entirely a financial dimension. Okay. Under the pressure of activists like the HCMC and others, what did they say? Very interesting. They didn't say very much. They said, essentially, companies, you have to disclose with respect to human resource management. The SEC was clear it wasn't going to go ahead and define what it meant. They knew what it was, and we all know what it was, but they weren't going to define it. That's both good news and bad news. Right? In the sense, it gives companies the freedom to define that, but provides no guidance. Second, within the broader context of their new approach to these kinds of regulations, principle-based rather than prescriptive regulations, they said, we're not going to tell you the categories or the metrics that you should use. Rather, you formulate them in light of the nature of your business operations, informed by some notion that your discourse about them is going to be about what is material. That is how the dimensions of human resource management, as it involves your company, are material to your enterprise in that kind of way.
So given the fact that you said that the point of view was from the investor's perspective and not the company's perspective, and the SEC basically said it's going to be principles based, we're not going to give you prescriptive data that you have to disclose. Don't you think that the SEC was basically handing it off to the investor community to say, you guys figure out what it is that you think you need to see to help you understand all the data and the matrix that would inform your decision making about return, risk and return as you evaluate investments?
I don't think it was that sophisticated. I think two things. One was I think the SEC didn't want to get, given where they were, this particular SEC was coming from, they didn't want to get in the middle. Second, there was a great
Yep.
deal of pushback from companies for a variety of reasons, resistant to anything
Right.
prescriptive with regard. So in part, that's why it's framed in that way.
Yeah, and we've got a really interesting legacy when it comes to disclosure of information from the Sherman Act that basically said you don't have to disclose anything about your employees because they're considered to be your competitive advantage. And so you don't have to disclose anything. And I think, that was the birth of pay secrecy and where we don't really tell anybody anything about, and I think we still live under that sort of legacy of thinking that human capital should not and does not need to be disclosed. But today's a different world. There's a lot more transparency. Employees are demanding information. We're seeing this new rise in equity where they want to see that they're being treated. They want the organizations to prove to them that they're being treated fairly in terms of pay and opportunity, right? The whole gamut of the social and racial justice movement. It's just a confluence of things. And I agree with you that when the SEC issued this disclosure requirement, it was under a different administration and a different tonality. I'm wondering what would have happened, and maybe you can prognosticate about this a little, if we would have been under a different administration. And now that we are under a different administration, do you think the SEC might actually alter what they're asking for? So, for example, for most of the world, companies have to disclose total cost of workforce, TCOW, everywhere except here. Don't you think that that's something that the SEC should actually require companies to disclose in one number, my total cost of workforce?
No, I'm sort of fast forward to we're going to talk about prognosis, but I'll fast forward to that. I think it's called the Workforce Disclosure Act, which came out of the House Financial Services Committee, I think, approved under the Democratic-controlled Congress, the House, didn't go anywhere. But there is a prescription for federally government, forget about the SEC, directly from Congress, federally directed disclosure. All right, and again, I think part of setting the SEC piece of it in a larger context, that's what I was trying to allude to. The floating around are going to be a lot of other initiatives. Certainly, you're going to have follow-up from the SEC itself. They'll be looking, particularly this SEC, will be looking at the disclosures. My guess is to evaluate them in some sense and decide what they want to do further with regard to that. A. B, in Congress, as I said, you had that legislation. I can't imagine that if a new version is impending, it will be at some point. I'm aware of an initiative at the state level mandating disclosure as well, which could be a major initiative.
Right.
That's on the government piece. There are obviously a range of initiatives on I'll call it the non-government side of the equation, whether it's SASB or GRI, all those. There'll be pressures and efforts ongoing in that regard. So the particular piece of SEC-related disclosure is just part of a larger set of developments, but in a way, under the pressure of the SEC disclosure, in a way provides both a challenge and an opportunity for companies, I think, to think through.
So let me build on that.
Yeah.
First of all, it's great. Thank you for the insights from the both of you. I'm just fascinated thinking about how we are processing, evolving what we think about human capital disclosures, right? And so bringing it back to materiality, we know that the guidelines are vague and companies have to figure this out for themselves, and everyone's going to have an opinion and pondering on how they should disclose to either investors or employees or to their communities at large. And you've already started hinting around other processes that will evolve outside of the SEC, right, and other regulations and others, either state, federal government, etc., or non-government related pressures that would influence how organizations will behave in terms of their materiality and disclosures. Let me turn that to the both of you again to ask a question around what do you expect to happen? What's going to happen in the next 12 to 18 months in terms of thinking of human capital management and disclosures and materiality? What could evolve? And again, you've already started hinting at that. Let me go to first Larry, since you've started talking about that, and I'll come back to you, Solange. What do you expect, Larry? What do you think is going or heading?
Well, again, I think there'll be what companies disclose within the context of the SEC. I guess it will be very important to the U.S. conversation. That will give a suggestion of what companies are willing to provide and why, and point to what other people might want to do. So that's why I said, in a way, it's a challenge and opportunity in a variety of senses for companies. That is, in a way, if they take up the opportunity in the right way, in a way they can help shape the larger debate about disclosure and the issues that lurk underneath it. That is, what are the issues that relate to workers and enterprises and how they contribute to those enterprises, and what do those enterprises mean for their lives. So I think that's why the SEC piece is very important. So again, I think you're probably not going to get legislation given the current configuration of Congress, but I think you will my guess is you will build toward some kind of thread of regulatory action. That's my best guess of where you're going to head in the near term in the United States.
Or is it possible that even if there isn't any regulatory action, that there could be some standards that the investor community can agree to, like the BlackRocks and the HCMCs of the world and the Opers and the CalSTRs and the CalPERS of the world can agree to, that says, if you want us to invest in your organizations, these are the 5 or 6 things that we want to see. And is it possible that this could be more of a grassroots, voluntary type of disclosure instead of a legislated one or a mandated one? Do you see that as a possibility, or is that's just not how we work in the United States?
No, that's possible. Let me sort of flesh that out a little bit. Let me take a step back. My thought has been, and I have not worked in a large enterprise, so I don't have the experience that you have, or insights that you have. But my sense is, by definition, a company has a business strategy, fully or less fully articulated. It has human capital, however you wish to phrase it, strategy. Right? In principle, that's the platform for disclosure. That is, almost by definition, those define what is most material to the success of the company, appropriately defined, even if only in financial terms. Therefore, in the abstract, it's a simple exercise to translate those to what you choose to disclose, subject to concerns about giving away competitive advantage, proprietary information, confidentiality issues, getting sued, and all that. So I well appreciate that. So in principle, my view is that, so on one hand, that companies need to draw on what they already have, for however good or less good it is. Second, they can do so with regard to their disclosures informed by the frameworks that are already out there. That is, they give you a sense of, at least from the investor side, though it's not only the investor side, there are other actors, right? Of what attributes or characteristics of companies relates to the workforce they think is important. There are reasons. It's always I'll call it the herd mentality. Yes, embrace a particular standard, because if everyone does it, we're safe, because everyone can appeal to it. I understand that instinct. My instinct, though, is do your own thing. But
the concept of collective wrongness, right?
Look,
if everybody's wrong, if somebody's wrong, but everybody's wrong, then it's okay because we're collectively wrong.
Okay, but in a sense, so in a way, respecting and taking into account whether it's SASB or GRI or the Workforce Disclosure Initiative, those, yes, I think it's extremely important that companies understand, A, why were those standards formulated? What informs them? And second, what's their character and what are their specifics? to inform their company's own thinkings about how does that relate to how we have thought about the issues for our company, all right? Insofar as how you translate your strategies into disclosure, that insofar as that can be informed and aligned with those standards, so much the better. But beyond that, I think the safest is to do your own thing.
I like that. I really like that a lot. Do your own thing. I mean, maybe just in the interest of time, Solange, can I ask you for your thoughts on, what might we expect in the near future as a final word?
Yeah, I think that we've got all the pieces in place. The term that's sort of floating through my head is organizations want to be the employer of choice. And we had this concept of being an employer of choice because that's what we needed to do to attract and retain employees. But now the concept of employer of choice has a different context for it, in that the more you're an employer of choice, the more economic value you're creating for the stakeholder, the employee, the community, your vendors, customers, right? And investors. And so I think what used to be given lip service, that employees are our greatest asset and we want to become an employer of choice, is not just a nice ideal. It is something that can be quantified, and that performance can be correlated back to financial performance, so that there's a new audience that's paying attention to what you're doing to become an employer of choice. So it's not just, do we have, people working for us, but what are we as an organization? Who are we as an organization to engage employees in a sustainable way? And I think that in the end is going to translate, and I think we know this intuitively, companies that do good do well. Now we've just got more of an impetus for that because somebody's going to hold our feet to the fire about it. The investor will.
So you know what? I would say let's end with that, because that's right. I agree with that. So really, Solange, Larry, thank you so much for this conversation. Really thought-provoking, engaging, and I hope challenging for our audience, right? Not only around terms that we may not be familiar with, but really thinking a little bit more deeply and broadly about what does it mean to have people engaged in our organization, and how does that translate into value for our organizations. So with that, I will say thank you to the audience for joining us. Thank you to you both, and we hope everyone has a good day.
This has been Insights from the Conference Board.